long does the IRS have to audit my self-directed IRA? Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's Ad Bits, we'll be chatting about statute limitations and your self-directed IRA. So statute limitations are important. That is essentially the time the IRS has to audit you. In most cases, the statute limitation is 3 years. Okay, that means the IRS has 3 years to audit you. Now, the question is, when does the 3 years start? In a basic income tax framework, whether it's an individual on a 1040 or a corporation on a 1120 or 1065 in the case of a partnership, generally the 3 years starts when you file your return, right? You got to put the IRS on notice. If you never file a tax return, the statute of limitation never starts tolling. Right. So if I actually have a friend who's a lawyer, believe it or not, who has not filed a tax return in 5 years. He claimed he was getting divorced and COVID. Don't ask. Anyways, I had lunch with him a couple months ago. We were chatting. He's like, oh, I'm out of the woods, a 3-year statute. And I'm like, no, you're not out of the woods. You haven't filed your return yet. The statute hasn't even started. So in the case of a self-directed IRA, we know IRAs don't file tax returns, right? So when does the statute start? Well, the belief is that, and this is confirmed by the IRS, is that each IRA has to file a 5498, and that is actually filed by the IRA custodian, not you. Okay, so you don't have that responsibility, but your IRA custodian does, whether it's Fidelity, Schwab, or IRA Financial. So the concept is your 3-year statute will start when you file, or when the custodian will file the 5498. Okay, so since the IRA doesn't follow 1040, it's not an individual, it can't actively file a tax return. So it's by the custodian, the byproduct of the custodian filing the IRS form 5498, it starts that 3-year statute of limitation. What about a 401k? Well, a regular 401k, an employer 401k like Apple or IRA Financial, has to file a 5500. So that's due July 31, and that is the tolling of the 3-year statute. What about a solo that has less than $250,000? Technically, it doesn't have to file the 5500 EZ. Well, the concept is, hey, since it's not obligated to file, that statute should automatically run on the date when the return should have been filed. Even though it technically wasn't required to be filed, the 3-year statute would start running each year. So you wouldn't, basically, the IRS wouldn't have an unlimited amount of time to audit your 401k if it had less than 250K because you never filed the 5500. The thought, or at least in the industry, is that 3-year will automatically run each year, even if you haven't filed the 5500, because you weren't obligated to file it in any event. Plus, you can make the argument that the entity, whether it was a sole proprietor or single member LLC, that filed the Schedule C, or the partnership or corp that filed 1065, 1120, that should have put the IRS on notice that there was a retirement account. Although that's probably not as good of an argument, because the IRS could certainly counter that there was no way of them knowing. Although that's necessarily not true, because there are lines on those forms that indicate contributions to a retirement plan. So that is kind of the thought pattern around solo Ks, that generally, even if you don't have to file because you have less than 250K, if you filed a tax return for your business that adopted the plan and made contributions, that would put the IRS on notice that the plan is there associated with that business. Could it ever be 6 years? Well, if you remember the Build Back Better bill, which was made public back in September 21, thankfully it never became law. There was a provision in there that made all IRA investments 6 years. The thought is that, hey, IRAs don't have their own audit division in the IRS. IRAs get audited under the Small Business Self-Employed SBSE division, and sometimes they just never get around to auditing IRAs, and when they do, it's too late. Remember Peter Thiel, where they definitely wanted to audit him, and unfortunately for Thiel and some of the other folks like Mitt Romney, the statute would have ran on the 3 years. So they would not have been able to audit them. So they wanted an extended 6 years. That provision never passed. Now, there's something called the Secure Act 2.0. It's possible that a 6-year statute could be inserted there, but not likely, but possible. And of course, a 6-year statute could be inserted at a later date, at a later bill. However, there is an opportunity for the IRS to assert a 6-year statute of limitation if there's something called a substantial understatement of income. That means if your tax return, okay, so if the error or the omission of the income that was left off your return is 25% or more of your gross income, then they have 6 years. So if your gross income was 100 grand and the potential understatement was 30,000, which is more than 25% of 100, they have potential to argue 6 years. So it's kind of hard to see how it plays for individuals, right? So let's say you did a prohibited transaction in 2020. Okay, let's say your gross income was 200,000, and let's say your prohibited transaction was 100 grand, right? You invested, and the IRS is now claiming it's prohibited transaction. Technically, they would have 6 years because the 100 versus 200 is greater than 25%. It's 50%. Now, I've been through IRS audits, and I have not seen them argue 6-year statute. In fact, in one case, the IRS conceded that they had lost certain claims due to a 3-year. And in those cases, the understatement penalty would have been higher than 25%. So it's not sure that at this point, a lot of the field agents are really focused on 6-year, but they may now, because the Build Back Better bill highlighted the fact that the IRS wanted 6 years for IRAs, not for 401ks, but for IRAs. That obviously didn't become law. Could it in the future? Yes. Could that change the thinking of agents who may now be more aggressive trying to argue substantial understatement of income and try to extend the 3-year statute to 6? Possible. But all in all, generally, the consensus is it's a 3-year statute. In IRA case, it's when the custodian files a 5498, which is end of May of the year. So if you did a transaction in 2021, the 5498 filed, in 22 for 21. So the 3-year would start at that point. Some people would argue that the 3 years should start when the transaction occurred. The IRS would counter that and say, hey, we need to be put on notice. So there's no way we would have known you did that transaction then. The only way we would know is when you filed some type of information return, whether it's a 5498 or some type of tax return. So generally, in some, it's 3 years. The IRS could, if they can argue substantial understatement, argue 6-year statute. That gives them more time to obviously go and audit you. And the intent for the IRS is to try to extend 3 to 6 for IRAs because they just don't feel like they have enough time and certainly enough manpower to go after IRAs. That may change, right? We all saw with the Inflation Reduction Act, which just passed the Senate, there is potential $80 billion of funding to the IRS over a 10-year period, anywhere from 40 to 80,000 more agents. I'm not sure about that number, but almost 60% of the 80 billion will go to enforcement. So there'll definitely be more agents out there, and they're going to have more manpower to go after everyone, including potentially, IRA. So that's why it is important to work with experts like IRA Financial who can help you navigate these rules and make sure that you're aware of all the potential pitfalls before you make your investment. So one last thing I want to add, if you do a prohibited transaction, generally the amount at issue is what was invested at that time. So say in 2019, you did an investment of 50K and now it's worth $3 million. If the prohibited transaction occurred, they will argue it occurred at the time of the investment. So you'd only pay tax and maybe a 10% penalty on that initial investment, not the growth amount. So that's actually, I've talked about this before. I've done an audit for a client and it worked out in his favor to actually concede and argue prohibited transaction because the investment he made was at such a low value. And now it's at so much of a higher value that he paid ordinary income tax at a low value. And now the rest was going to be capital gains since it was going to be distributed and determined that it was owned in his personal name. So obviously it was a pre-tax, that wasn't a Roth, but just keep that in mind. In 3 years or 6 years, if there's a prohibited transaction, it's for the amount invested, not for the fair value at the current amount. So that's often, a good thing. Generally, they'll go after tax. They have the ability to issue an excise tax. I've rarely seen them do it. If you settle with them, if you go to tax court, they will impose it. But if you settle, it's generally just tax. And if you're under 59.5, they'll generally just ask for the 10% penalty as well. But again, it's on the amount invested, which triggered the prohibited transaction, not necessarily the current fair market value. So hope you guys found this podcast helpful. If you're watching on YouTube, thank you. Don't forget to subscribe. It's a great channel. We drop 3 podcasts, 3 to 4 videos, and a live video that I generally do Wednesdays at 12 Eastern Standard Time. Sometimes it's Tuesday, but generally Wednesdays. That could be Thursdays too. That's why you should subscribe, because you will get notification when I go live. And if the topic's of interest, then you could check it out. So if you miss it, don't worry. Obviously, it's on YouTube. Same with these podcasts. This is a weekly podcast that drops every Tuesday. You can obviously listen to it wherever you listen to your podcast. But if you miss it, it's available. And it's also on our YouTube channel if you want to take a look and watch it instead of listen. So thanks for spending some time with me today. Hope everything's great and your summer's going well. Take care, be well, and talk to you again next week.